Hello guys, welcome to another video. Today I've decided to make a video about one setup for life by THOR, which is my YouTube name. Um, so the reason I decided to make this video is because I got a couple DMs about um, from the people in the group. They've been asking me about I want to be a sculptor. What should I do? I'm getting confused in between the time frames. What should I be focusing at? So there is a little bit of overthinking, overcomplicating things and stuff like that. So hopefully with this video, um, I'll be able to address all those problems and solve it once and for all. So the main focus of this setup, I'm sure, like many of you all already aware of this, as I've covered this in the videos and the live streams and all that several times, but I've never addressed it directly. So today, that's what I'm trying to achieve here. So one step for life. Um, the setup is pretty simple, pretty straightforward, and as you guys know me already and my trading style, the setup is revolving around dealing ranges, market maker models, and divergence as well. So without those three elements, there's no story behind any price move, and there is no way to read the price action. Okay, so let's dive into the charts and see. Let's take a look at it. All right, guys, let's dive into the charts. Now here I'm looking at Nasdaq June contracts on the 15-minute. Now the reason I'm looking at the 15-minute is because actually I'm not going to pull ES just yet. So here it took sell side, expanded higher, and in that expansion, it consolidated a little bit after the expansion, right? So in that consolidation, market actually formed here at these lows and S&T divergence. So that is the first bullish S&T divergence. And because the S&T divergence is on the 15-minute, staying on the 15-minute to find a framework. Okay. So it's not that I love 15-minute or whatever. Whichever time frame gives the framework or the divergence, stay on that time frame to find your framework. By framework, I mean literally two things: liquidity, dealing range, that's it. And actually three things. The third one is point of interest to find a setup at that level, at that range, or whatever the case is. This could be discount, premium, range EQ. So here, that SMT divergence, you don't long this, you wait for it. You wait for the first leg, okay? Let's move forward. So now it's expanding higher. Here, it starts stalling. So now price is accumulating. What that means is the high could be the first leg's high, meaning expansion leg high. It's not confirmed yet though, because the range, accumulation range is this. Unless it breaks out to the downside or to the upside, doesn't really matter. The expansion leg, the first leg's high is not set yet, so you gotta wait for that for dealing range purposes, okay? Move forward. Okay, with this candle, it break out of the range, right? So the accumulation is over. Now it has to move. That means, because it broke the range, that means the high here becomes the expansion leg high or the first leg high. Let's call it expansion high. Also, the buy side. Now that is confirmed. And then you have the first leg, the whole move from the divergence all the way to the high. This leg is the first leg. So whenever you see people drawing the price moves like, oh, hold on, where's that tool? Here. Whenever they, you know, draw the price move like this portion, see, nope, I didn't want to do that. This portion of that leg is this portion. Okay, the whole move from S&T low though. It's not from the manipulation. Okay, it is from the S&T low. That is the first leg. So now let me clean the chart a little bit. Now once the high is set and then you have the low, the S&T low becomes what? It becomes the expansion low or sell side. Now this is the sell side liquidity. Once you have this, now you have a dealing range, which becomes your um, framework. It becomes the framework. So from the sell side to buy side, this is the framework. Now here, what I'm looking at is the mid level of that dealing range of that first leg. So this is the range equilibrium. And the reason I'm not looking at the range equilibrium like with these boxes is because range EQ is one specific, one precise level. It is 777.75 in this case, and that's it. It's not a range. You don't take it like, oh, this is my range EQ. No, range equilibrium is one level, which is why I love working around range EQ. It is one level. You're not looking at the range. Like, you're not looking at rectangular boxes, for example. Like, oh, between these two levels, that's my range. No, it is one precise level. And the reason, that's the main reason I'm looking at the range EQ with this one dashed line. It's because it's precise level. Because it's precise level, I am waiting for a precise reaction from that level. Okay, that's it. That's why I'm looking at it. So by drawing the framework, it allows us to find the premium or see the premium and the discount. Discount is below range EQ. This becomes the discount. Now, you guys already know this. Once market starts, this, once market starts or forms their smart money reversal at this point like that, two things can really happen. This is 100% conditional. One, if price reacts off of range EQ, that is a pullback, okay? And if price violates with displacement at range EQ, that is a displacement. Displacement. Okay, period. It's like literally either or. Okay, and that gives you the whole idea of drawn liquidity. Meaning, so you say you establish this dealing range, you know the buy side, you know the sell side, you know the premium discount, all those things. You wait for price to come down into range EQ before doing anything else. And you look for a reaction. Now, if it reacts, if it finds supports at the range EQ, what that indicates is buy side is the drawn liquidity. So it becomes, the price becomes drawn into buy side more likely than the sell side. Now, the vocabulary here that I'm using is very important because it is a probability game, okay? Trading is absolutely like about probabilities. Now, what you need to do is you need to put the coin in your favor. So once it gets down here, find supports, then you say, okay, it is likely going for the buy side, okay? Maybe 90% to 10% compared to the sell side. Now, if it disrespects or like violates the range EQ with displacement, now you can say it is likely to draw into the sell side. Let's look for short setups or stay flat because I was looking for buy side delivery. You can do either or. There's nothing wrong with that. I like to let it go. Depends on the day, but it's up to you because I like to see price doing what I anticipated. Then I can be on side and be confident. Okay, so let's see what happens after this. Let's move further. Now here, traded down into range EQ. First body is respecting. Second body is also respecting. Now, because the two bodies respecting. So now you have a drawn liquidity. Now you can say it is likely to draw into the buy side. And this buy side is also what we call is low hanging fruit. Meaning It is the highest probability draw on liquidity or highest probability buy side liquidity, because this is also it's not a home run or whatever. The home run would be maybe like there's a daily sell side buy side over here, and if you try to long it over there, that's a home run. But this, because you're literally remember the framework, you're literally like targeting the first high on the first expansion. That is a base hit. Okay. Now, once price trades down into the range, you still need to stay on the 15-minute until it trades down into the what do you call it? The range EQ, because you got to see that it's respecting on the relative time frame. Okay, once it does that, now you can go down to 1 minute to find executions. Okay, now here's the important thing. Like the reason we go down to 1 minute is because we're mainly trading futures contracts. Okay, and we're day traders, guys. Like, um, I really don't want to see anybody having like 30-point plus stop loss on Nasdaq when they're trading day trading. Okay, it doesn't even matter if you're trading prop firms or not. 30-point stop loss on on Nasdaq is a no-no. Period. So if you're looking for setups or executions primarily on 5 minute, 15 minute, I can tell you this: you're doing it wrong. You gotta go down, go lower, because you gotta refine your entries, your executions, your stop loss, and all that. Okay, because time is fractal. Like if I don't show you this chart and the time frame, you won't be able to tell me which time frame it is. It could be 1 minute, it could be 1 week. Okay, so whatever you see on the 5 minute and execution wise, you're gonna see it on the 1 minute once it gets down into your POI. Okay, so now the POI is being restricted on the 15. I can go down to 1 minute and see what happens on the one. Now, the pullbacks end by two ways. Okay, the first way is, I mean, actually one way in two subcategories. So the way is what? Smart money reversal. Now you guys know this. How does smart money reversal forms? Two ways. One, traditional smart money reversal with SMT divergence at the lows if it's bullish. Two, the trap, right? Price accumulation, then fair value gap, and it confirms the trap and sends the price, right? So here I'm watching the price. It's 6 a.m. though, but anyways, let's keep watching it. Here it seems like having a hard time breaking out here. I'm gonna pull up ES as well on the one. Let's see. Wednesday 22, 6 o'clock. The only example I found is funny, 6 o'clock. All right, let's see. Here is the price action. Okay, I found it. Now here, as you can see, this is a trap, yes, but price is forming a bearish S&P divergence. So unless ES or Nasdaq goes above this high, you don't have a setup. So let's see what happened here. Comes down to the trap fair value gap and breaks down. Now that confirmed the S&P divergence. This setup is invalid for now. You still don't have any reason to execute long positions here on the 1 minute basis. Okay. Now we are still waiting. Now I'm waiting for price is still going down on the 1 minute. Here I'm still waiting. This could be an accumulation. I mean, I wouldn't consider this an accumulation, but let's wait. So here what I'm looking at is a market structure shift. There's no trap here. There's no accumulation. So what I'm looking at is there's an order block here. If this order block fails, now we have a what? We have a breaker, which is market structure shift. Let's see. If it breaks out, then we have a setup. Tries one more time. Still haven't gone above. All right. So here it violated OV and it's trading above. Now there, this becomes the breaker block. There's a market structure shift. Now you can look for long anyways. But let me look at ES real quick, just because I want to be aware of any SMT divergences. Here, this is the high. This is the high here. There is no SMT divergence so far. Okay, cool. So there is a reason to go long here. Go long. Stop losses. Like you can do a couple things here, but for the sake of this conversation, let's say you put it below this fair value gap or below this low here. Don't mind the 5 contract, by the way. I didn't change this. Just don't mind the numbers here, okay? I'm just trying to showcase it. And then you have the long. Let's move on. Broke out. Range EQ. Displacement. Now you can put your stop loss at break even at this point. And then what I want to do is I'm going to go on the 15-minute, because this is the time frame that we're working on here. And I'm expecting a buy side delivery, okay, on the 15-minute. And after one expansion like this on the 15, you can put your stop at break even. Let's see. And this is the TP. Okay. We go further. Trading down into, this is the, I wouldn't call it trap, but this is BPR. Trading down into BPR. You trust that BPR, it shouldn't violate. And boom, it tagged the buy side. This is one setup for life, guys. Now let's take a look at this price action on the 1 minute as well after the long. So here, breaker, displacement, fair value gap, displacement. Now you have what? You have a new dealing range on the 1 minute, right? So any pullback down into like here, whatever, these lows, it's going to be into range equilibrium on the 1 minute, right? So what you need to do is you pull up ES on the 1 minute. If you look at SMT divergences here, if there's an SMT divergence down there, you take that as your sell side. This is the range high. Okay, let's see if there is an SMT. Oh yeah, yeah. Okay. Nasdaq making high low. ES is making lower low right there. So you take that low as your sell side, or as your first leg low, range high. Now you can expect a pullback if price stalls into range EQ. If you have stop loss below range EQ, okay, in this case, your stop loss was a break even, you're doing it right. Your stop loss should be safe if you have the correct draw on liquidity. Then comes down to range EQ. Goes one more time. This should be an S&P divergence as well. Let's take a look at it. This low, that low, and there's this. Okay, the S&P divergence is prior. This is the S&P. Here Nasdaq making, yes, making higher lows. Nasdaq making a lower low. That's the S&P divergence after range EQ. This could be a pyramid entry as well, if you wish. And goes for the high. Now, there is another setup here. It's literally the same thing on just on the 1 minute this time. I'm gonna delete everything. Forget about the 50-minute now. But this is what I mean by time is fractal. Okay. I'm gonna keep that S&P average. Just keep that in mind, okay, guys. Here, price takes the sell side and displaces S&P divergence here, causes the first leg on this time frame. So from the S&P low to high becomes the first leg. Now, if that's the first leg, once the high is set, this is literally the same thing on every time frame, guys. Expansion high slash buy side slash low hang fruit objective. Then you have the sell side at the S&T low. This is expansion low slash sell side slash, there's no slash over there. Now, once you have that down, you'll look at the dealing range. from SMT low, high, comes down into range EQ, forms a smart money reversal in the form of SMT divergence, comes down to rejection block, you can feel that, comes down to OB, you can feel that, comes down to these fair value gaps here, you can feel any of those, and target the low hanging fruit objective for the base hit, the base run. It's the same setup, but under 1 minute. One setup for life, guys. Okay. Here, let's say you long the first fair value gap, 17.50. Your stop loss below SMT low, which is 7.75, THOR, boom. Low hanging fruit objective, then you call it a day. Okay. I hope you guys find this insightful. It's pretty straightforward. So you got to do two things. Three things. Establish THOR, establish liquidity. Look at range EQ. Range EQ is your point of interest. Okay. If it respects, target the most recent short-term high, the most recent or short-term buy side. If it displaces lower, the low range EQ, target the short-term sell side. That's pretty much it. Now let's take a look at another example on another time frame. This is a great example because it already formed in a couple different time frames, 15-minute and 1 minute within the same framework. This is a great example. The great example for time frame doesn't matter. Okay. Let's delete all that. Let's take a look at change the time frame. Let's take a look at on the hourly. Okay, I remember this one. Let's take a look at this one. This is the CPI low. There's an SMT divergence here. Okay. Now, I'm not gonna put it in the replay mode anymore because I don't have to. You guys know the deal now. I'm gonna pull up ES so you can see the divergence. I'm not bullshitting. Here. Then price expands. So you let the first leg go without executing. You can execute, but this is just like the one setup. You're trading the second leg. Okay. Now here, the first leg high. Why that high? Because it is, oh, where's my rectangle? Consolidating. Smooth edge. Breaks out to the downside. The range is broken now. So the high becomes what? It becomes the expansion leg high. Expansion high slash short term DSL slash low hanging fruit. Then once this high is set, we have the sell side, which is the S&P divergence low. Sell side slash expansion leg low. Now, once it's there, you have what? You have the dealing range. From SMT low to high, you got the dealing range. Now you expect price to pull back into the range EQ. So you're not trading anything in this move. Not trading anything in this move until it comes down. Okay? You're not trading in the middle. Wait for it to pull back. It comes down into the range EQ. Once it touches there, let's go on the replay mode. Solid bar before it touches. Or you know what? Let's make it touch. Now it touched there. Once it comes down to range EQ, switch to the lower time frame, 1 minute in this case. Expansion like high, because it's respecting. Now you say, okay, the chances of rating the short-term buy side is more likely than rating the sell side because it's respecting the range EQ. Okay. Now your job, once you understand that, is go down to lower time frame, look for executions, and as you can see here, it looks like sell side of the curve. Now it's going for the buy side of the curve in the market making model, right? Here, let me zoom in to this price action on the 1 minute. Let's see what's going on here. There's no trap. Let's take a look at the ES, so we can find S&T divergences. It's here. How can I come there though? Okay. May 17. ES on 1 minute. Okay, May 17 right here. Cool. Now you're waiting for a smart money reversal on the one to go long and target the short-term buy side here. And in the meantime, you have to um, keep the hourly chart at all times somewhere here on in your monitor because the main framework is on the hourly chart. You're just narrowing things down into 1 minute to find an execution. That's it. But your main framework, I want you to understand that is on the hourly. So you have to keep that on the chart at all times while you're chasing this rally here. So here, let's see if there's any divergence. Zoom in a little bit. Da, 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 da. I think you can take this equal lows. Not my favorite type of divergence, but it's there. Then it expands higher. So the first fair value gap is right there. Here, let me go back on the one. Here, you buy that fair value gap. You can look for early executions too, by the way. You don't have to, you're not restricted with fair value gaps. So what you can do is, as this SEC divergence forms, you can look at maybe this breaker block, or maybe you can look at this or is it not that one here, maybe as an order block, or this one propulsion block. You're not restricted with this type of entry. But right now, since I'm not being able to watch it live, I can't walk you guys through that, but once the S&T divergence is there, so after that, this candle forms the swing low. So 1, 2, those two candles, you can find an entry with those two candles because the S&T divergence is confirmed. Okay. Now that is the first fair value gap. Let's say you long that, and your stop loss will be below the S&T low here. Then you long it. Don't look at the numbers, guys. Like I said, I didn't change the 5 contract thing. You can also use, there's nothing wrong with that, by the way, because this is a fair value gap already expanded on the one. You can use this low too. There's nothing wrong with that. That low also shouldn't get failed because it formed multiple fair value gaps already. Well, let's watch the price. And also the target is low-hanging fruit objective on the hourly. Right about there. Now let's run it. I'll go like this. On any pullback, I'm gonna pause this real quick. On any pullback, there's no pullback just now. It's consolidating right now. It could cause a pullback, but no, it broke out. I was thinking about maybe if it breaks the range here to down, I would be looking at range high to range low on the 1 minute. This is the range EQ, so I would be looking at a bounce from there. And it will be the same setup. You would be longing this position or longing this price action at the range EQ. If it reacts, targeting the low-hanging fruit objective high buy side offer. That's better because it means the price is strong. So let's run it. Still no pullback. Now there's a break here. In this case, what you have to do is, because it kind of broke the range, structural shift is there and stuff. Now let's take a look at ES. About there. Any divergence in between those lows will be the expansion leg low. That's what I'm looking at. We can anticipate a dealing range here. Not that we have to, but Um, wow, I don't see any. Yep, it's still here. So your range would be this, and you would be already break even your position, stop loss. You could use the range EQ or anything below. So here, for example, this low, you could use that as your stop loss, and you run it. Let's say you kept it on the break even. Obviously, you wouldn't normally, but let's say for the sake of this conversation, still accumulating, not forming any highs in the lows. This could pull back right now. Range EQ is still the same. If it pulls back, you're looking at the range EQ. Now it broke out though. Shouldn't come to this level anymore. Now here, if these lows are S&T diverges, you have a new short-term viewing range. Comes down into range EQ. So let me check S&T divergence. Here are these lows. Yep, I think it's there. Oh, is it there or not? There is one here, but it failed. I don't see an S&T here. I don't see an S&T just yet, so I'm gonna delete that. Still expanding. Now at this point, like you would be watching price on the hourly. That would be healthier. Here it broke down. Let's see what's going on there. Broke down. Still no range EQ though. And still no S&T divergence. This is the overnight price actually, by the way. Now your main framework is the hourly at this point. Because your target is on the hourly, the S&T divergence is on the hourly. It's just I'm watching the price on the 1 minute because the execution was on 1 minute. We need to always execute. But this is because the time frame is the hourly, this is usually the either the weekly point drawn liquidity or a couple days out usually. So here, hold on a second. I gotta stop this. You have a new dealing range. Let's see if it's going that low. Couldn't come down there. Broke out and tagged the high. So that high is low-hanging fruit objective on the hourly. But here I want to look at something. So the only SMT divergence is there. And before the drop, it formed the high. Failed to reach down there. If it did though, it would have been even better. So that's another entry. So now let me take a look at, this was the execution, Friday, May 17th, and the rally happened on Monday. Okay, but we established the drawn liquidity way before by using this setup. You guys already know this setup, by the way. Don't get me wrong, I'm not inventing anything. You guys already know this. I've mentioned this several times. But because I'm still seeing some confusion in some of you, I wanted to just like focus on one thing in depth. So it could potentially, you know, help and get rid of the confusion once and for all. Um, But one thing I want to say is because we find the log entry somewhere here, for example, this was the log entry somewhere there. I'm not sure. I'm not looking at like a precise level. On the 1 minute, it was somewhere here. This was the low hanging fruit objective buy side. I don't remember the stop loss, but let's say it's there. So here, as the hourly candles expand, okay, here's what I'm trying to say. Hold on a second. Let me pull up Nasdaq hourly. Okay, you're watching this price. Now, as it expands, or after your entry, this is how you should be watching this, your position. This, like, on the one side, it's on 1 minute chart. On the other side, it's the hourly chart. Because price will respect to with the hourly PD arrays. So you can manage your position better because the setup is on the hourly. You're targeting the hourly buy side. You're targeting the hourly short-term buy side. The S&T divergence, the dealing range is on the hourly chart. If that makes sense. The S&T divergence is on the hourly chart. Okay, that's why you need to be um, watching multi-time frame at the same time. On the one side, it's your framework time frame, wherever the S&T and the range is. On the other time frame, it's 1 minute because that is where you execute things. Okay. And now as it expands on the hourly, that's why you need to roll your stop loss. So here, for example, if you roll your stop loss into profit, let's say maybe like it expanded here, right? If you put your stop loss below this level, let's say on the 1 minute, by looking at the 1 minute, it would stop you because it doesn't have to, but it's not a safe stop because the PD array on your framework time frame, there is a CB, BC, rather, fair value gap, and that's the only fair value gap. Once it pulls back, it's going to go down there. It did that rally, so you would get stopped in profit, yes, but I think you get the point. If you don't, just hit me up anytime you want. But this is it for now. It's if you guys have any questions or anything, please do not hesitate contacting me, DMing me. Um, I try to go over my DMs almost, I can't say every day. Sometimes I really feel exhausted after market close, but I try to look at it pretty often. So yeah, do not hesitate with any kind of questions. Or if you want to talk about something, feel free to do so. I'm more than happy to have a conversation with each one of you. But for now, hope you guys find this insightful, and I'll talk to you later. Have a great weekend.